Welcome. My name is Nathan Faith, and I'm here with my partner, Joe Bloodgood. And the topic of conversation today is Roth conversions. Joe, would you like to introduce the strategy?
Thanks, Nate. Yeah, absolutely. So a Roth conversion is actually a really pretty simple concept. It's really taking money you might have in a 401k plan or a traditional IRA, paying tax on the conversion amount in the year of the conversion, and turning it into a Roth IRA. Now, why would you do that? Nate, let's talk about why that might be a beneficial thing for some of our clients.
Thanks, Joe. Why in the world would anyone want to pay taxes early? That's the million-dollar question when it comes to tax planning strategies, specifically the Roth conversions. Tax laws can change, but now we have more clarity on how they may change than we probably have ever before. In front of you is a graphic that illustrates the current law on the right versus the old but also future law on the left. First, I want you to notice two things. Tax rates are lower, basically across the board, in the current tax landscape than under the future one. And secondly, the amount of income that can be taxed or recognized at those rates is much more significant. For many of our clients, we feel this may be a tax planning opportunity of a lifetime. For instance, presently a married couple can convert about $1/3 at or below the 24% federal tax bracket. Why is that so important? Because 5 years from now, that same married couple could convert about a fourth as much, $80,000, before they are paying more per dollar than they would on the much larger amounts today. The key with tax planning is know where your tax targets are at and then execute your strategies year by year. Joe, could you walk through an example of how this strategy could be put into action?
Absolutely, Nathan. So let's take a look at a common scenario we see with our clients. So we'll have an individual who's worked for many, many years and saved up significant dollars in qualified plans like 401ks or traditional IRAs. And sometimes they have a gap between the time they stop working and the time when some of these automatic sources of income kick on. So things like Social Security and required minimum distributions. So let's say we've got here somebody who retires at 62 and they've got $1.5 million in a pre-tax vehicle. Really thinking back to your last slide, Nathan, it's as simple as sort of eating the elephant one bite at a time. We look back, we had up to about $1/3 in those cooler tax brackets. So essentially what we're doing here is we're targeting about $300,000 a year over the course of 5 years. And under the current tax law, we're not exceeding the 24% bracket on the federal side. And over the course of those 5 years, we're able to turn $1.5 million of income that will likely be taxed at a higher rate in the future into tax-free income by locking in our tax bracket, hedging against higher rates in the future, and all the while providing a great vehicle that could be used for legacy planning or gifting purposes in the future. So if you have any questions about this or if this might be right for you, contact us at learnmore@boulaygroup.com. Again, it's learnmore@boulaygroup.com.